In late December 2025, the global financial system stands at a peculiar and dangerous intersection. On the surface, markets appear functional, liquid, and orderly. Stock indices hover near historic highs, credit continues to flow, and policymakers speak confidently about resilience and soft landings. Yet, beneath this apparent stability, a set of interconnected alarms is sounding simultaneously across every major asset class. These alarms are not isolated warnings. They are signals of a systemic imbalance that has been building for over a decade, one that now threatens to unwind in a manner more destructive than any financial crisis in modern history. In New York, equity valuations have reached extremes that rival and, by some measures, exceed those seen before the crashes of 1929 and 2000. The S&P 500 trades at a Shiller CAPE ratio near 39, a level surpassed only at the height of the dot-com bubble. Corporate profits, the foundation upon which these valuations rest, are increasingly fragile, propped up by years of cheap debt that no longer exists. At the same time, commercial real estate markets across the United States are quietly collapsing. Office buildings valued at $180 billion in 2021 are now worth closer to $90 billion, yet banks continue to carry them on balance sheets at inflated values near $145 billion. These losses remain unrealized, obscured by accounting conventions, but they have not disappeared. They are latent, accumulating pressure that will eventually be released. In the bond market, an even larger threat looms. Over the next 24 months, approximately $13.7 trillion in corporate debt must be refinanced. Much of this debt was issued during an era of near-zero interest rates. As companies attempt to roll it over at rates 2 to 3 times higher, profitability collapses. Defaults become inevitable. The scale of this refinancing wall alone ensures a default cycle that will rival and likely exceed the credit crises of 2008. What makes the coming crises fundamentally different from every previous crash is not the severity of any single problem, but the way all of these problems are structurally linked. This is not a stock bubble, a housing bubble, or a credit bubble in isolation. It is an everything bubble. Stocks, bonds, real estate, private equity, and speculative assets have all been inflated simultaneously by 14 years of zero interest rate policy and unprecedented monetary expansion. When everything is overvalued at the same time, everything corrects at the same time. There is no refuge. Historically, financial crises have been ace. In 1929, equities collapsed by nearly 90%, but bonds retained value. Stock ownership was limited to a small fraction of the population, and the damage, while severe, was concentrated. In 2008, housing prices fell dramatically, and equities lost more than half their value. Yet government bonds rallied sharply as investors sought safety. Diversification worked. Policymakers had room to maneuver. Interest rates were cut from over 5% to zero, trillions were printed, and fiscal stimulus stabilized the system. The conditions entering 2026 are fundamentally different. Every major asset class is overvalued relative to historical norms. Total debt levels are far higher than in any previous crisis. Policy tools are largely exhausted. Passive investing has introduced new forms of fragility, and the pain, when it arrives, will not be confined to a narrow segment of society. Today, nearly 60% of Americans own stocks, directly or indirectly. A market collapse will destroy middle-class retirement savings on a scale never before seen. To understand why the coming collapse is likely to exceed both 1929 and 2008 combined, one must examine the structural forces now converging. The first and most obvious factor is valuation. Equity markets are priced for perfection at a time when earnings are increasingly vulnerable. The CAPE ratio, historical average, is approximately 17. Even a partial reversion to 25 levels still considered elevated would require a market decline of more than 35%. Other valuation metrics, such as the Buffer indicator, place total market capitalization at over 230% of GDP, more than double its long-term average. Margin debt has reached levels that, historically, have preceded major crashes within 18 months. The concentration of market value in a handful of large technology firms further amplifies risk. The so-called Magnificent Seven represent nearly one-third of the S&P 500 and trade at valuations more typical of speculative growth companies than mature global enterprises. When these valuations decompress, trillions in market value evaporate, dragging the entire index down with them. The second factor is debt. Total U.S. debt now exceeds 140% of GDP, far higher than in 2008, and nearly triple the level seen in 1929. Corporate debt alone stands at $13.7 trillion, much of it issued under assumptions that no longer hold. When debt reaches such extremes, the process of deleveraging becomes far more destructive. Defaults cascade through the system, impairing lenders, investors, pension funds, and insurers simultaneously. The third factor is the absence of effective policy ammunition. The Federal Reserve enters this crisis with interest rates already elevated relative to recent history and a balance sheet still bloated from previous rounds of quantitative easing. While rates can be cut, the marginal impact is limited. Printing trillions more dollars risks undermining confidence in the currency itself. The tools that mitigated previous crises are now blunt, politically constrained, and potentially counterproductive. The fourth factor is market structure. Passive investing now dominates equity ownership, with over $11 trillion in index funds compared to just $1.2 trillion in 2008. These vehicles do not assess value or fundamentals. When markets fall and redemptions occur, they sell mechanically, amplifying declines. Risk parity strategies, volatility targeting funds, and derivatives-based hedging systems further accelerate selling as prices fall, creating feedback loops that did not exist in previous eras. The fifth factor is societal exposure. In 1929, stock ownership was limited to a small elite. Today, retirement accounts, pensions, and savings plans tied the financial well-being of most households directly to market performance. A crash no longer devastates only the wealthy. It erodes the economic foundation of entire generations. The sixth factor is globalization and speed. In earlier crises, contagion spread over months or weeks. In the modern system of algorithmic trading, global derivatives, and instant communication, contagion spreads in hours. There is no time for gradual adjustment. Finally, the magnitude of overvaluation across all asset classes simultaneously is unprecedented. This is not one bubble. It is 7 interconnected bubbles: equities, corporate credit, commercial real estate, residential housing, private equity, cryptocurrency, and sovereign debt. The collapse mechanism follows a predictable sequence. Equity markets fall first as earnings disappoint and valuations compress. Margin calls trigger forced selling. Household wealth declines sharply, leading to reduced consumption. Falling demand erodes corporate revenues, justifying further equity declines. As companies struggle to refinance debt, defaults rise, crushing corporate bond prices. Losses spread to pension funds, insurers, and banks. Banks, already burdened by unrealized losses in commercial real estate, face simultaneous hits from equities, bonds, and loan defaults. Depositors lose confidence, triggering withdrawals. Banks sell assets to meet redemptions, realizing losses that further erode capital. Credit freezes. Lending stops. Economic activity grinds to a halt. Unemployment rises rapidly. Mortgage delinquencies increase. Housing prices fall sharply as forced sales accelerate. Household net worth contracts by tens of trillions of dollars, reinforcing the downturn. The cycle feeds on itself. Government intervention eventually follows, but with diminished effectiveness. Monetary easing and fiscal stimulus arrive late and at great cost. Inflation resurges even as the economy contracts, producing stagflation. Rising yields inflict losses on bondholders, including institutions once considered safe. By the end of the cycle, all 7 bubbles have deflated simultaneously. Equities fall by more than half, Corporate bonds lose a third of their value. Commercial real estate collapses. Housing declines by nearly 40%. Private equity and speculative assets implode. Government bonds, once the ultimate refuge, suffers significant losses. The total destruction of wealth exceeds $34 trillion in the United States alone, and nearly $90 trillion globally. Recovery is slow, uneven, and complicated by inflation. Some assets never fully recover in real terms. This outcome is not the result of a single shock or policy error. It is the inevitable consequence of a system in which every asset class was inflated simultaneously by cheap money, leverage, and complacency. When diversification fails, when debt is excessive, and when policy tools are exhausted, the correction is not contained. It is systemic. The lesson of the coming collapse is not merely that bubbles burst. It is that when everything is a bubble, everything bursts together. There is no safe haven, no easy escape, and no historical precedent for the scale of adjustment required. This is not financial advice. It is an analysis of systemic risk, and it suggests that the period from 2026 to 2027 will be remembered not as another market downturn, but as a structural reset, one that exposes the limits of leverage, the fragility of financial engineering, and the consequences of believing that cycles had been abolished. History does not repeat exactly, but it does rhyme, and the rhyme now forming echoes louder than any heard in a century.